Welcome we're done. Dumalang molo sababono hukandat. And a warm welcome to the Induvo Knowledge Cast, the deep dive where your curiosity meets insightful conversations. Today we're diving deep into the thrilling world of, you guessed it, accounting. Okay, I know what you're thinking, accounting. Seriously. But trust me, this isn't your average balance sheet snooze fest. We're talking about IAS 29, the international accounting standard that deals with hyperinflation. Now you might be thinking, hyperinflation, what's that got to do with me? Well, imagine this. You're at the spaza shop ready to buy a loaf of bread and the price tag says R10,000. And by the time you get to the till, it's already jumped to R15,000. That's hyperinflation, when prices go up faster than a taxi driver switching lanes in peak hour traffic. And IAS 29 is the rule book that helps businesses make sense of their finances when the rand is doing the washo.
You got it. It's like trying to build a house on shifting sand. Everything's constantly changing, and the old rules just don't apply. IAS 29 steps in and says, hold up, we need a different approach. It's like switching from a teaspoon to a bucket when you're trying to measure a flood.
Okay, so let's break it down. What exactly is hyperinflation? I mean, we all know prices go up, that's just life in Mzansi. But when does it cross the line into hyper territory?
Well, think of it this way. If you'd rather stash your savings in a mealy pap tin buried in the backyard than keep it in the bank, that's a pretty good sign you're dealing with hyperinflation. Seriously, though, there are some key indicators outlined in IAS 29. One is that people lose faith in the local currency. They start using foreign currencies like the US dollar or even barter for goods and services.
So it's like when Gogo starts using her stash of Krugerrands to buy groceries at the market. That's a red flag right there.
Absolutely. And another sign is when prices are quoted in a more stable foreign currency. It's like everyone saying, forget the rand, let's just use dollars. And of course, there's the classic symptom of prices going up, 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 even for short-term credit. It's like trying to outrun a cheetah. You know you're going to lose.
Yeah, it's like everyone's playing a game of beat the clock with their money, trying to spend it before it loses even more value.
You got it. It creates this frenzy where people are rushing to buy things even if they don't need them because they know their money will be worth less tomorrow, and that can lead to even more inflation. It's a vicious cycle.
Yeesh. So how does IAS 29 help businesses in this financial roller coaster? What does it actually tell them to do?
It boils down to one key concept: restatement. Imagine you're trying to use a 20-year-old map to navigate a city that's changed drastically. You're going to get lost, right? Well, that's what it's like trying to understand a company's finances during hyperinflation without restatement. You need to update the map, so to speak.
So we're talking about adjusting those financial statements to account for inflation.
Yeah.
Making sure they're speaking the same language as the current economic reality.
Exactly. It's like giving those statements a fresh coat of paint, updating them to reflect the current value of the rand. And the key tool for this makeover is a general price index. Think of it as a special ruler that changes size to match the inflation rate.
So we're taking this magical price index, waving it over the numbers, and poof, inflation-adjusted financials. Sounds like some serious accounting wizardry.
Well, it's a bit more technical than that, but you've got the spirit. The index helps businesses recalculate the value of their assets and liabilities. For example, let's say a company bought a delivery truck a few years ago. In today's money, that truck is worth way more than what they paid for it, right? Restatement uses the price index to show that.
Yeah, it's like saying, okay, that truck was a bargain back then, but in today's inflated world, it's worth a small fortune.
Exactly. And that's the essence of restatement, bringing those historical numbers into the present inflation-adjusted reality.
Okay, so we've got companies restating their financials using this price index thingamajig. But what about those financial statements themselves? How do they actually change? Let's start with the statement of financial position. What happens there?
The statement of financial position. A snapshot of a company's assets, liabilities, and equity at a particular point in time. Now, in a hyperinflationary environment, some of those numbers need a serious update.
So are we talking about throwing out old receipts and shredding outdated bank statements?
Not quite, but you're getting the idea. We're talking about restating those figures to reflect their current value in the face of inflation. Remember that general price index we talked about earlier? That's our trusty tool for this job.
So we take our price index, wave it over the numbers like a magic wand, and piff, inflation-adjusted figures.
Almost. It's a bit more technical than that, but you've got the spirit. Basically, we use the index to adjust non-monetary items, things like property, plant, and equipment inventories, and even goodwill, things you can hold or touch, essentially.
Hold on, goodwill. The warm, fuzzy feeling a company has. How do you put a price on that, let alone adjust it for inflation?
Goodwill, in accounting terms, is the premium paid for a company over and above its net assets. Think of it like the extra you pay for a vintage car because it's got a cool history. Now, because goodwill is tied to the original acquisition, it needs to be restated to reflect the current value of money.
So it's like saying, okay, that vintage car was a steal back then, but in today's inflated market, it's worth a whole lot more.
Precisely. And that's the essence of restatement, bringing those historical numbers into the present inflation-adjusted reality.
So let's say we've got a company with a big shiny factory they built a few years back. How would we restate that on the statement of financial position?
We take the original cost of the factory, then apply the change in the general price index from the date of construction to the end of the reporting period. So if inflation has been running high, that factory's restated value could be significantly higher than its original cost.
Makes sense. It's like saying building a factory today would cost way more than it did back then. So let's reflect that in our books.
Exactly. Now remember, not everything on the statement of financial position needs to be restated. Monetary items like cash and receivables are already expressed in current terms. They're like chameleons, always adapting to the current value of money.
So it's like saying that R100 note in your pocket is still R100, even though it can buy you less borrowers than it could a year ago.
Haha, you got it. Now there's one more interesting thing about the statement of financial position in a hyperinflationary environment. The net monetary position we discussed earlier, IAS 29 requires companies to be very clear about this. It's basically the difference between a company's monetary assets and liabilities. If they have more assets than liabilities, inflation might actually help them out, as weird as that sounds.
Wait, so you're saying that if you're drowning in debt, hyperinflation is like a sneaky little life raft? Who knew? But seriously, folks, this net monetary position thing is important because it shows how inflation can actually benefit some companies while hurting others.
Precisely. It all depends on whether you have more monetary assets or liabilities. It's like a game of financial seesaw. And inflation is pushing one side down while the other goes up. And IAS 29 wants businesses to be transparent about which side they're on.
Okay, so we've got companies restating their financials using this magical price index and figuring out their net monetary position. But what about the other financial statements? What happens to the statement of comprehensive income? How does that get restated?
The statement of comprehensive income. The grand tale of a company's revenues, expenses, and ultimate profit or loss. Now, under IAS 29, this statement also needs to speak the language of inflation-adjusted figures.
So we're not just talking about tweaking a few numbers here and there. We're rewriting the whole story of the company's financial performance, taking inflation into account.
Precisely. Remember, in a hyperinflationary environment, comparing figures from different periods can be like comparing apples and oranges. A profit from last year might mean something completely different in today's inflated world.
It's like saying, sure, we made a lot of money selling those bunny chows last year, but with the price of bread skyrocketing, who knows what the profit margin would be today?
Exactly. So under IAS 29, every line item in the statement of comprehensive income gets restated to reflect the measuring unit current at the end of the reporting period. That means revenues, cost of sales, operating expenses, the whole shebang.
So if a company sold a bunch of widgets a year ago, we need to adjust that revenue figure to reflect what those widgets would fetch in today's market and the cost of making those widgets too, right?
That's right. And the same goes for the cost of those widgets, any operating expenses incurred, and so on. It's like recalibrating the financial compass to navigate the choppy waters of inflation. Every transaction gets adjusted.
So it's not just about adjusting for the rising price of bread, it's about adjusting for the rising price of everything. Makes sense.
Precisely. Every transaction, every expense, every bit of income gets brought into the current context. It's a comprehensive overhaul, making sure the statement of comprehensive income paints an accurate picture of the company's performance in this inflationary world. Not a job I'd want to have.
Now I'm starting to see why IAS 29 can be a bit of a headache for accountants. It's not just a few tweaks here and there. It's a whole new way of looking at financial statements.
You're absolutely right. It can be complex, but it's essential. Without these adjustments, the figures would be misleading like a mirage in the desert. You think you see water, but it's just an illusion.
And in the world of finance, illusions can be very dangerous, especially in a hyperinflationary environment.
Exactly. IAS 29 aims to dispel those illusions, to provide a clear, consistent, and comparable view of a company's financial performance and position. It's like installing a powerful headlight on that financial car so we can see clearly where we're going, even on the bumpiest of roads.
Okay, so we've covered the statement of financial position and the statement of comprehensive income. What about the statement of cash flows? Does that get left out of the inflation makeover party?
Not at all. The statement of cash flows, which tracks the ins and outs of cash, also gets a touch of the IAS 29 magic wand. It's all about making sure the figures are expressed in terms of the measuring unit current at the end of the reporting period. Remember, consistency is key.
So we're not just looking at how much cash came in and went out. We're looking at what that cash was actually worth at different points in time, like how much buddy chow you could buy.
Precisely. If a company received a wad of cash a year ago, that wad might have a different purchasing power today. The statement of cash flows under IAS 29 reflects this, ensuring we're not comparing oranges and nard cheese.
So it's like saying, sure, we had R1,000,000 in cash flow last year, but with inflation running rampant, that R1,000,000 doesn't buy as many biltong snacks as it used to.
Aha, you've got the picture. Every cash flow, whether from operating activities, investing activities, or financing activities, gets restated to reflect its current value. It's like adjusting the zoom lens on our financial camera, so we can see the cash flow picture with clarity, even in a blurry inflationary landscape.
Now I'm starting to see how IAS 29 brings this whole hyperinflation thing into focus.
Yeah.
It's not just about adjusting individual numbers, it's about adjusting the whole financial narrative. It's like rewriting the company's financial history in inflation-adjusted ink.
Beautifully put. That's exactly what IAS 29 aims to do. To provide a clear, consistent, and comparable view of a company's financial performance and position in the face of hyperinflation. It's like giving those financial statements a superpower, allowing them to stand strong even when the value of money is crumbling around them.
Okay, so we've got the financial statements all dressed up in their inflation-adjusted outfits. What about disclosures? Does IAS 29 require any special shout-outs in the financial reports? Like a little note saying, warning, these numbers might make your head spin.
Absolutely. Transparency is paramount, especially when dealing with something as complex as hyperinflation. IAS 29 requires companies to be upfront about the fact that they've restated their financial statements, making it clear that the numbers reflect the current value of the currency.
So it's like an honesty badge, assuring investors and stakeholders that the company isn't trying to hide anything about the impact of inflation on their financials. Hey, we're playing by the rules, even if the rules are a bit crazy right now.
Exactly. Transparency builds trust, especially in a volatile economic environment. And beyond just stating the fact of restatement, IAS 29 also requires companies to disclose the method they used, the price index they chose, and the movements in that index over time. It's like providing a behind-the-scenes look at the inflation adjustment process, giving everyone a glimpse into the accounting magic that's been performed.
So it's not just about showing the final result, it's about showing how you got there. Transparency on transparency, as they say.
You got it. And this level of disclosure is crucial for allowing investors and analysts to make informed decisions. It's like giving them the key to decode the financial statements, helping them understand the true impact of inflation on the company's performance and position.
Okay, so let's say a company has been diligently following IAS 29, restating their financial statements year after year. Then suddenly the economy stabilizes and hyperinflation is a thing of the past, like poof, it's gone. What happens then? Do they just go back to their old ways of doing things?
Nope. IAS 29 has a specific rule for this situation. Once an economy ceases to be hyperinflationary, the company treats the restated amounts from the previous period as the new basis for their financial reporting. It's like saying, okay, we've crossed the turbulent river of hyperinflation and now we're on solid ground. Let's use this new inflation-adjusted starting point for our journey ahead.
So it's not a sudden U-turn back to the old ways. It's a gradual transition, carrying forward the lessons learned from the hyperinflationary period. Like, okay, we survived that craziness, but let's not forget what we learned.
Exactly. The impact of hyperinflation is lasting, and IAS 29 recognizes this. It's like saying, we've been through a financial storm, and even though the skies are clear now, we need to remember the lessons we learned about the importance of adjusting for inflation. So IAS 29 is not just a rule book for hyperinflation. It's a guide for navigating economic uncertainty and ensuring financial transparency. It's like a trusty compass, helping companies find their way through the fog of financial complexity.
I like that analogy, a trusty compass, especially when you're dealing with something as unpredictable as the rand.
You know what else is interesting? This whole idea of restatement isn't just some theoretical exercise. It's actually been used in countries all over the world that have faced hyperinflation. It's a real-world tool that's helped businesses stay afloat in some pretty crazy economic storms.
Okay, spill the tea. Who are these hyperinflation culprits? Give us the inside scoop.
All right, but let's not name and shame. But you're right, some countries have become almost synonymous with hyperinflation. Think Zimbabwe in the late 2000s, Venezuela in recent years, or even Germany in the 1920s when a loaf of bread could cost a suitcase full of cash.
A suitcase full of cash for a loaf of bread.
Yeah.
That's wild. No wonder they needed a whole accounting standard to deal with that mess.
Exactly. And it's not just those extreme cases. Countries like Argentina, Brazil, and even South Africa have had their own brushes with high inflation, requiring companies to pay close attention to IAS 29 and its principles.
Wait, South Africa? Are you telling me we've been flirting with hyperinflation? Have I been living under a rock?
Not quite hyperinflation, but we've definitely had periods of high inflation that have made IAS 29 relevant for South African companies.
Hmm.
Remember the 1980s when inflation was running amok? Or even more recently when the rand took a nosedive and prices started climbing? Those were times when companies needed to dust off their IAS 29 manuals and make sure their financial reporting was on point.
So this isn't just some far-off concept that only affects other countries. It's something that has real implications for businesses right here in Mzansi.
Absolutely. It's a reminder that inflation can happen anywhere, anytime. And it's important to have tools like IAS 29 to navigate those challenges.
Okay, so we've established that IAS 29 is used all over the world, including our own beautiful South Africa. But let's get down to the nitty-gritty. What are the real benefits of applying this standard? Why should companies bother going through all this trouble of restating their financials?
That's a great question. And the answer is simple. IAS 29 is all about painting a truer, more accurate picture of a company's financial health in a hyperinflationary environment. It's like taking a blurry photo and bringing it into sharp focus. It helps us see the underlying reality without the distortions of inflation.
So it's like those Instagram filters that make everyone look 10 years younger. But for financial statements, give those numbers a facelift.
Haha. Well, not exactly. It's more about removing the distortions caused by inflation. Think about it. If you're looking at a company's profits over a few years and inflation has been eating away at the value of money, those profits might seem much higher than they actually are in real terms.
It's like saying, wow, that Spaza shop made R1,000,000 last year. But wait, with inflation, that R1,000,000 is only worth half as much now, so their real profit is much lower.
Precisely. IAS 29 helps cut through that confusion. By restating the financials, it shows what those profits really mean in today's money. It's like giving investors and analysts a clearer view of the company's performance without the distortions of inflation.
So it's like a truth serum for financial statements.
Yeah.
No more hiding behind inflated numbers.
Exactly. And that transparency is crucial for making sound investment decisions. Investors want to know what they're really getting into, and IAS 29 helps provide that clarity.
Okay, so transparency is one big benefit. What else does IAS 29 bring any other goodies to the party?
Oh, it brings a whole goodie bag. For starters, it promotes comparability. By using a consistent standard like IAS 29, investors can compare companies across different countries and time periods. Even if those economies have experienced different levels of inflation, it's like having a universal translator for financial statements.
So you can compare a company in South Africa to one in, say, Argentina, even if their currencies have been on completely different roller coaster rides.
That's right. It's like leveling the playing field, making it easier to spot the real winners and losers, regardless of where they're operating.
That's pretty impressive.
Yeah.
So transparency, comparability. Any other benefits we should highlight? Don't hold back.
Well, IAS 29 also promotes better decision-making by providing a more realistic picture of a company's financial health. It helps management make more informed choices about investments pricing and even whether to expand or contract operations.
So it's like having a GPS for navigating the business world, helping companies avoid potholes and dead ends, especially those financial potholes.
Exactly. It's about providing the right information at the right time, so companies can make the best possible decisions in a challenging economic environment.
Now, that's what I call a valuable accounting standard. It's not just about crunching numbers. It's about empowering businesses to thrive, even when inflation is trying to throw them off course.
You've got it. IAS 29 might seem complex at first glance, but its ultimate goal is to simplify, to clarify, and to provide a solid foundation for financial reporting in a world where the value of money can be as unpredictable as load-shedding schedules.
Okay, I love that analogy.
Yeah.
As unpredictable as load-shedding schedules, that's the perfect way to describe the South African economic landscape.
Right. You never know what's going to happen next.
But even with a superhero standard like IAS 29, there must be some challenges, right?
Yeah.
No system is perfect. What are some of the criticisms or difficulties associated with this standard?
You're absolutely right. No accounting standard is perfect. And IAS 29 has its share of critics.
All right, let's hear it. What are the skeletons in IAS 29's closet?
Well, for starters, some argue that it can be complex and subjective, especially when it comes to choosing the right price index and making those adjustments. Remember, we're dealing with a lot of judgment calls here, not just plugging numbers into a formula.
So it's not as simple as waving a magic wand and poof, inflation-adjusted financials.
Unfortunately not. It requires judgment expertise and a deep understanding of the economic environment. And with all that judgment comes the potential for manipulation, which is a concern for any accounting standard.
The age-old problem of people trying to cook the books. Even with a fancy standard like IAS 29, you can't completely eliminate the risk of some creative accounting, can you?
Sadly, no. That's why it's so important to have strong auditing and regulatory frameworks in place to keep those creative accountants in check. It's like having a referee on the financial field making sure everyone is playing by the rules.
So even with IAS 29, we need those watchdogs to keep the game fair and square.
Absolutely. Transparency and accountability are key. IAS 29 provides the framework, but it's up to the players, the companies, the auditors, the regulators to ensure the game is played with integrity.
Okay, so complexity and subjectivity are two challenges we've identified. Any others we should mention? Give us a full rundown.
Well, some critics also argue that IAS 29 can be backward-looking, focusing too much on historical costs and not enough on future prospects. They say it's like driving a car while looking only in the rearview mirror. You might miss what's coming up ahead.
So it's like saying, okay, we've adjusted for past inflation, but what about the inflation that's brewing on the horizon? IAS 29 doesn't have a crystal ball, does it?
Nope, it doesn't. That's why it's important to complement IAS 29 with other tools and analyses like forward-looking projections and sensitivity analyses. It's about using a combination of historical data and future-oriented thinking to make the best possible decisions.
So it's like having a navigation system that shows you the road behind you. A&D gives you real-time traffic updates, so you can adjust your route accordingly.
Exactly. IAS 29 provides the historical map, but we need other tools to navigate the road ahead.
Okay, we've journeyed through the ins and outs of IAS 29, from its technical bits to real-world examples. Now it's time for my favorite part, putting on our thinking caps and going beyond the textbook. I always find it fascinating to explore the why behind the what. Expert speaker. What's one thing about IAS 29 that makes you stop and think, that's interesting?
You know what always strikes me is the human element behind all this. We talked about numbers and rules, but imagine running a business where the value of your money is evaporating faster than a puddle in the Karoo sun. It must be incredibly stressful, almost surreal.
Yeah, absolutely. It's like that saying money talks. But in a hyperinflationary environment, it's more like money is screaming, spend me now before I'm worth nothing.
Exactly. And that psychological impact is huge. How do you make rational decisions when the ground is constantly shifting beneath your feet? How do you plan for the future when you don't even know what the currency will be worth next week? IAS 29 helps businesses navigate the financial side, but there's a whole other layer of human resilience and adaptation that comes into play.
It's like those survival shows where people are stranded in the wilderness. They need to figure out how to find food, build shelter, and stay mentally strong, all while dealing with the unpredictable elements. Hyperinflation throws similar curveballs at businesses, forcing them to adapt or perish.
That's a brilliant analogy. It highlights the need for creativity, resourcefulness, and a whole lot of mental fortitude. It's not just about crunching numbers, it's about leading teams, reassuring customers, and finding a way to thrive in a truly chaotic environment.
It makes you wonder if there are any parallels between how individuals cope with hyperinflation and how businesses do it. Like, do people start bartering their skills or stockpiling non-perishable goods the same way companies might shift their investment strategies? Is there a shared psychology at play?
That's a fascinating question. I think there are definitely some overlaps. Both individuals and businesses have to find ways to preserve value, minimize risk, and adapt to a rapidly changing landscape. It's like a collective dance, everyone adjusting their steps to stay in sync with the unpredictable rhythm of the economy.
So it's like a whole society doing the Vo show, trying to keep up with the beat of hyperinflation.
Yeah.
But on a serious note, it makes me think about the importance of financial literacy, not just for business leaders, but for everyone.
Right.
If we understand how inflation works, how it impacts our lives, we're better equipped to make smart decisions, whether it's about our personal savings or our voting choices.
Absolutely. Knowledge is power. And in a hyperinflationary environment, understanding the financial forces at play can be the difference between surviving and sinking. It's like having a map and a compass in a dense forest. You might not know the exact route, but you have the tools to find your way.
And speaking of maps and compasses, that brings us to the end of our deep dive into IAS 29. We've explored its technical depths, its real-world applications, and even its psychological implications. It's been a fascinating journey, and I hope you've all come away with a newfound appreciation for this often overlooked accounting standard.
It's been a pleasure. Remember, everyone behind those seemingly dry accounting rules are stories of human resilience, adaptation, and the constant pursuit of a stable and fair financial system. Even when the Rand is doing the VOSHA, we can find ways to make sense of the chaos and build a brighter future.
Well said. And on that note, we'll say Hapa Kali for today. Until next time, stay curious, keep learning, and remember, knowledge is power.